let's go back to our trade tab here for a second. Our spread between the bid and the ask price. The bid and the ask has a spread on it. It could be a penny, it could be 2 pennies, it could be 3 pennies, it could be 4 pennies, it could even be 5 pennies per contract. And what you do is you're selling at the bid and you're buying at the ask. So as soon as you buy something for $1.32, if you had to go back into the market and sell it immediately, you would only get $1.26 for it. So that is the reason why you have an immediate loss as soon as you put this position on, because nobody gives you anything in the markets. You're not going to make a penny. In fact, you're losing a penny every time you put on a position. The only way that you're going to be making money is through the analysis of your positions and the way you manage them in the future. Here's how you make your money, though. The way you make your money is by this white line over a period of time will begin to rise until it meets the green line at the expiration date, which is on May 17th. So we can take a look at this a different way. If we go back up to our plot lines here for a second, let's just make sure our probability date over here on the right side is accurate. It should be set to the day of expiration, which is May 16th. Okay. Now we're going to go to plot lines and we're just going to go to day step here. Let's take a look at this. See, what happens is eventually this white line will come up and meet. Let's just do it this way. I'm just going to go up day by day. You can see our current date is the 19th. The green line is 425. So within 1 week, we should have our white line will move from this point of, actually because the price is over here, a loss of $5.81 up to a profit of $5.13. If we keep going, moving up our date line, remember our expiration, the expiration of these contracts is May 16th. And generally, we'd like to close these out about a week before expiration. So probably close to May 9th, we're going to be taking a look at closing out this position. But if the prices remain relatively stable, then we can continue to increase the date. Now we're at April 30th. April 30th, we're in a position where we have a profit of $17. If we continue, now May 4th, you can see that the profit continues to rise as we get closer to expiration dates. Now let's say we start closing out our position on May 9th. If we hold our position from April 19th to May 9th, which is only a couple weeks away, you can see that this white line has increased dramatically to the point where we are making a profit. And that is exactly the goal of what we want to see happen. We want to see this white line continue to rise and rise and rise, and that means that we will have a profit here of $50 for each contract that we put on. So we put on one contract, we're going to get a profit of 50 bucks. Now, how much did that one contract actually cost us on this iron condor? It only reduced our buying, because we received a credit, it only reduced our buying effect of $109. Now, if we were to close out this position and the price, remained relatively stable and it didn't move, let's just assume that just for a second, although that rarely happens, but it does happen once in a while, and we close this position out on May 9th, which is about a week before expiration, for a $50 profit. What kind of a return on investment is that? Well, we only really had to put up a margin money of $109 and we got $50 in return. That's almost 50% profit. And how long did we have to hold this trade? Well, we put it on April 19th and we closed it on May 9th. May 9th. That's about 3 weeks. 50% profit in 3 weeks. Let's just take a look and see what happens if we increase the number of contracts. Instead of one contract, we do 2. Well, now it only costs us our margin is only $218, but now we have a profit of $100. We're still at 50% profit in 3 weeks. Well, let's take a look at 3 contracts. 3 contracts, we only put up $327, and we have $150 in profit. So we're still very close to 50% profit in 3 weeks. Now, when you start to get into really significant amounts of profit, and you're really good at what you're doing, now we're putting up $2,000, and in 3 weeks we have a profit of $1,000. And we start to play in the big time, and you're really a player, and you're doing 50 contracts at a time, you're putting up $5,000 in margin money, and you're making $2,500 in just 3 weeks. Okay? And this is on one position. So the profits can certainly be significant. This is the way that you would use this this Analyze tab, just to determine exactly what your profit position is going to be over time. If we took this all the way to expiration, as you can see, I day stepped it. This is actually May 17th, which is the day after expiration. You're going to see this is almost exactly like our profit and loss figure that we looked at when we initially opened up the position. And our maximum profit on this position is $4,544 if we did this many contracts. Of course, when you're starting out, I do not recommend that at all.